We're delighted to have our National Head of Research with us today doing the main presentation, Stephen McNabb. He'll set the scene for, the national market and in the context of Adelaide. He'll drive in some key insights and what's happening around our state. And then following that, we'll have a panel discussion, which will be led by our National Head of Projects, Ari Petrovs. And there'll be a panel discussion, which will be myself, Phil Rundle, Alistair Laycock, Pottenger and David Reid.
Recovery in the next phase of growth. The major factor that's influenced the Australian market, which is all over the headlines, is the attraction of foreign capital to Australia. And if you just look at the big picture over the last 10 years, you can see that we've attracted over $20 billion worth of foreign investment into commercial property. South Australia has also attracted a bit over $500 million. It's a very similar proportion to the national number. So drilling into Adelaide, what's been happening in the market? It's a fairly steady market, Adelaide, compared to the national market in terms of the turnover or transaction activity cycle. You can see that we're back to close to average, back to normal, about 500 million per annum. Principally, consumer and housing as a whole is a positive. It's a positive here in South Australia. Dwelling approvals are up 25% year on year, so it's benefiting from the same sort of patterns of growth driver that you're seeing in a state like New South Wales at the moment. The South Australian economy will benefit from an improvement in demand. It will see an increase in net absorption. Most of that will come from the health sector and the education sector. If you look at the motor vehicle piece by itself, this is our estimate, across the country of what that actual exposure is in terms of floor space. And you can see there that directly and indirectly motor vehicle manufacturers in Victoria and South Australia occupy around 5 million square metres of space. It's about 1.6 million Holden in Adelaide. That's the space at risk, they're the red pieces of that analysis. But that logistics growth that underpins an economy, you can see over the next decade, clearly overshadows and more than offsets that reduction in space. So what this means is you get a change in the mix and a change of the use of the space over time. And it's a natural progression. We've seen it before. For office investments, how will Adelaide perform versus the national market? I think it will perform ahead of the national market. Vacancy peaks earlier. Rent growth is an issue everywhere, so it's not a differentiator, but you have a higher starting yield. So in that environment, it actually would be a better performer than the East Coast markets over the next 3 to 5 years. If you look at retail, as I said, I think that performs in line because we're following a very similar cycle in terms of the demand underpinning that and what will drive rent growth. So I think retail is still going to perform in line. Within retail though, you'd look for those cyclical sectors again. It's things like large format retail that have really underperformed since the GFC. They're areas where you can expect yield compression as a beneficiary of that improved demand environment. And finally, industrial. I think relative to where we've been, Adelaide performs below the national average. And the reason I say that is because there is less scope for yield compression here on that rent profile I showed you than there is in markets like Sydney and Melbourne. So I think industrial over the next few years will actually perform a bit below the national average.
think Adelaide has in fact performed stronger than you all probably think. You know, words like recovery and stability and conservativeness have never really been the aspirational words related to economies, but I think if you look at Adelaide, it's prospered and succeeded and finds itself in a stage of early recovery ahead of other markets.
Well, I think we're seeing a definite undertow of strong demand coming into our marketplace from the logistics sector, and we've seen that through the Electrolux facility at Beverley, which is a 25,000 square metre facility built to service the local market. We've also seen that with the Aldi facility being built out at Regency Park, which is an 8-hectare site. Metcash are in the market for a significant facility as well, all to cater for the local domestic market. There's a new facility out at for Rand out at Edinburgh Parks or Direct, and that again is another example of that move towards logistics. Where we're seeing the weaknesses are clearly in the secondary market. If you have a secondary asset, you're going to get punished. The clear factor in that is the functional obsolescence that we're seeing with that type of facility. They're typically orientated towards singular occupation, and they don't lend themselves to the requirements of a logistics operation.
I think from a retail point of view, it's definitely slow and steady, cautious. We've certainly had an encouraging start to 2014. The obvious vacancy levels don't always reflect clearly what's happening in the market in Adelaide. For example, with Rundle Mall, there's only one true vacancy, but it doesn't reflect what's actually happening with 8 or 9 off-market tenancies being offered. So, I mean, we've definitely seen a tightening in the problem strips. So, probably looking at Jessie Road, Glenelg and Hyde Park, King William Road. Vacancies definitely tightened there. Take-up's generally been from, I would say, at least 8% of food and beverage. That's where we see a good 80% of our inquiries day to day is food and beverage.
What they are all looking for, they're all looking for the same product. It's all about security. It's all about quality of the tenant, long-term lease, new product. None of that is news to anyone, but the demand looking for that clean, neat asset is really significant.
I use the term from Adelaide, we're cautiously optimistic about the office market. We track demand really closely for the obvious reasons, and we have seen probably a 25% uplift in the first quarter this year to the last quarter last year.
If we've got a vacancy rate at 14%, we know that obsolete buildings and other capitals get removed from the numbers and turned into residential. The CML building in Adelaide is undergoing that conversion at the moment, so that's been taken out of the figures. If the CML building was still in the figures, Bahr is at 8,000 metres of space there, so we'd be talking 15%, not 14%. So then begs the question of that 14%, how many more obsolete buildings are sitting in there that are just never going to be leased and don't represent real vacancy? So I'd almost argue that our real vacancy rate, our operating vacancy rate, is more like probably 12 and a half maybe. It's if you think through the number of vacant, obsolete buildings, it's got to be relevant.
Thank you. In the interest of time, I'll just run through each of you and ask for your tip. Alistair, starting with you.
Oh, look, I think it's an opportunity for a bit of profit-taking for owners or developers who've built stock, held it for, say, 4 or 5 years, and they've still got 5 to 7 years left on their lease tail. The demand is there from the investment sector. So, yeah, put it on the market and test the market, and you won't be unhappy.
Tenant retention, I think. Just talking to your tenants, keeping them there. I don't think the market's strong enough to let them go. And look at your properties. Look at how you can increase their value, and their looking at changing shop fronts, increasing the height. There's lots to be done on each tenancy to make them more appealing. Certainly if they are vacant. So, but yeah, tenant retention, I think.
I think those prior generation CBD office buildings that might have a little bit of vacancy, I say again, don't be scared of a little bit of vacancy given the metrics we've got at the moment.
Well, with a massive demand for investment stock at the moment, we'll see an opportunity to turn corporate-owned assets into sale and leaseback opportunities. And obviously with the functional obsolescence in the market, together with the growth in logistics needing new space, I think there'll be new design and construct opportunities moving forward as well.
Tenants are probably more fickle when it comes to presentation than they've ever been. Certainly tenant rep involvement has that impact. Simple things, end-of-trip facilities, bike parking, they all sound, we all laugh at it and say, they want showers and locker rooms, but, every tenant we speak to talks about those facilities. And if they're not in your building, they get across. It's not just the presentation, though, it's also the performance. We talk, and neighbours' ratings are as real as they've ever been.
I hope we've been able to provide you with some food for thought, some good insights into what the market is doing at present.